Hi everyone, welcome to today's video. So let me start today's video by showing you a chart and asking you a very important question. If you answer this question correctly, then you will automatically get the clarity whether or not you should be selling your portfolio in this market or you should be buying more. So here is the important chart. What you would notice is that in the 2000.com crash, the market crashed a lot. Then it took 3 more years to recover. So the total recovery time was 7 years. Then look at crash number 2, which lasted from 2008 that the market crashed. And then it took markets roughly 4 years to recover. Then in 2020, market crashed and it recovered almost immediately. And now the markets are going down and 2 camps have been created. On one camp, we have investors like Mr. Ray Dalio. He's saying that, you know what, there is more crash to come because similar crashes have happened in 2000, similar crashes have happened in 2008, and it took market a lot of time for recovery. On the flip side, we have another camp, slightly more optimistic camp. This is Mr. Warren Buffett. So Mr. Warren Buffett, he has not purchased a lot of stuff from 2020 onwards. He was sitting on massive amount of cash, and very recently he made an investment of $20 billion. Where did he make that investment? I will disclose the share names as well. And if you want, I'll do further analysis of those shares. But the point is that the world is right now divided, saying that right now in 2022, we are witnessing something called a super bubble. There is more crash to come. The stock markets might crash by 50-60% more. You might lose your savings. Recession is coming. Stagflation is coming. Everything is going to dust, this and that. Okay, so from that viewpoint, which narrative should you be believing in? I will present an economic analysis of this entire situation. You will learn very important concepts around macroeconomics. So please watch this video till the very end and also press the like button. It indicates to me that you would want me to make these type of videos. Also along the way on the video, I will give you rational explanation as to what was the difference between 2000, 2008, 2020 and 2022 bubble, so to say. So let us get the discussion started, and first and foremost, let us systematically try to understand the point that is the current crash of 2022. Is it going to get bigger, and is there more pain to come in the stock market? So for that, let us very quickly touch upon the commentary by Mr. Ray Dalio, and here is what he says.
And so they will not be able to raise interest rates to a high enough level to adequately provide a real return.
So he uses a very interesting statement where he said that, hey, real returns are not there. Now, what is meant by real returns? Very, very important concept for you to understand. So please bear with me here. So real return simply means that, for example, that if you are going and depositing your money in a fixed deposit right now, the rate of interest that you will get is between 5 to 6%. But what is the inflation in the economy? It is close to 8%. So are you making any real returns? The answer is no. In fact, you are losing money. You are losing roughly between 2 to 3% if you're doing fixed deposits as of now. Now, what are fixed deposits? Fixed deposits are an asset class. They are a part of the bond market. So there are different asset classes that you could consider. For example, you could consider US equity. You could consider Indian equities. You could consider corporate bonds. You could consider government bonds. You could consider something that starts with C and ends with O. You could consider something like real estate. So Mr. Ray Dalio believes that you are not going to make real returns from majority of these asset classes, and he is correct. So can I prove that to you? The answer is absolutely yes. If you consider major US stocks, which is Apple, Tesla, Netflix, Google, Amazon, and look at the last 6-month performance, you will quickly realize that majority of these stocks have fallen between 20% to something like Netflix, which has fallen by 70%. So there is a major crash that has happened in equity asset class already, both in India and the US. Now, this is a very important table that will help you understand that where these bubbles have already crashed or have already corrected. For example, if you consider equities as an asset class to be a bubble, where corrections have already happened quite aggressively. So I would say that US growth or technology oriented stocks have already been crushed. There is massive correction that has already happened. If you consider Indian banking stocks, technology stocks, startup stocks, they have also been crushed quite aggressively. So the point is that if you go back 6 months back, this bubble might have been this size. But over the last few months, it has slightly shrunk in size. Now, can it fall further? The answer would be very stock specific. But let me pick the example of Microsoft. There is a video that I had done on Microsoft. You can go and check it out. That will help you understand more about Microsoft and why did I purchase it. But let me show you some key data around Microsoft. If you take the last 6-month performance, Microsoft stock has corrected by roughly 18%. Now it is trading at a PE of less than 30. So now I do not think that Microsoft or a stock like Microsoft is going to fall further. Now let me go back to that table and try to explain you more points. So when it comes to equities, I feel that US growth stocks have already corrected quite aggressively. Can they fall further? The answer is yes, but at least the good ones have already corrected quite a lot and they are trading at a reasonable enough valuations. This is the first key point. Second, if you consider some of the Indian stocks, the same story plays out because Indian equities and US equities work in conjunction. Then comes the second asset class, which are cryptos. Have they corrected quite a lot? The answer is absolutely yes. And when I say cryptos, I'm only talking about Bitcoin and Ethereum, the two cryptocurrencies that I consider to be the best cryptocurrencies. So cryptos also have corrected quite aggressively. Why? Because they function exactly like US tech stocks. So here also the bubble has somewhat deflated. Now comes bonds. Now bonds are a very interesting instrument and they are one of the most misunderstood instruments out there. Some key points that you need to understand about bond market is that here, if you assume that the size of bond market bubble is this much, and if there is enough scope for correction left, then what is going to happen? What is going to happen is that the entire other asset classes will also get beaten down. Why? Because when stocks get beaten down, cryptos also get beaten down. When cryptos get beaten down, stocks also get beaten down. So this type of beating constantly happens if the bubble is bursting in any of these subcategories. So I hope this point is clear. Now let me try to analyze what is going to happen in the bond market in the next few months. Because if the bond market gets corrected, then it might lead to stock market fall also. So we might witness certain bit of correction. So let us very quickly look at the data from the bond market. Now, if you look at the bond yields means returns, what you will notice is that over the last few months, the bond yields have been going up. They have went up from roughly 0.6 or 0.7% all the way to 3%. Now, here is a very important concept that you need to know about bonds, that there is an inverse relationship between yield or interest rate and prices. What this means is that if yield or interest rates are going up, then prices are going to come down. So the simple point that I'm trying to explain is that the bond market right now is undergoing correction. Why? Because the prices of bonds are falling. That is the simple message that I'm trying to communicate. So again, if we summarize the entire video up until this point, what do we learn? Number one, we learn that equities have corrected quite aggressively in the US. Some really good stocks like Amazon, Apple, Microsoft, they have come down at reasonable PE valuations. Number two, Indian equities have corrected quite a lot. Cryptos have corrected quite a lot. Bond market correction is already underway. Now, as Feds keep on increasing the interest rate, there will be more bond selling that will happen. Now, can the bond market fall further? The answer is yes, it can fall further. That will impact the stock market also. But to cut the long story short, here is the key message that you need to understand. The key message is that a large part of correction is already over at this stage. Do I see the stock markets correcting quite significantly from this time? The answer is no. Now, let me tie together two macroeconomic concepts that will help you understand what is likely to happen going forward in 2022. So, I would want you to revisit this chart of S&P 500 and notice a couple of things. 2000, it took almost 7 years for recovery. 2008, it took almost 4 years for recovery. In 2020, it took a few months for recovery. Now we are going sideways. There has been a little bit of correction. Now going forward, how much time do you think the recovery will take? So this is my analysis and I will back it up by giving you macro data also, that if you consider point number 1, point number 2, point number 3 and point number 4, there has been a fundamental shift in macroeconomics that has happened. And there is huge difference between these 2 points and these 2 points here. What is that difference? It is called as the velocity of money concept. Now, what is velocity of money? Let me pick an example and try to explain you that viewpoint. So basically consider this box to be US, India, Japan, etc. right? And imagine that there is a lot of money that is flowing through this economy, right? So whatever is the amount of money flowing through this economy can be termed as the velocity of money. Now, if you go to 2000 .com crash or if you go to 2008 banking crash, what used to happen here? Here, the quantitative easing was very less. Quantitative easing simply means that the rate at which the governments were printing money, that was very less compared to 2020 crisis. In fact, 2008 crisis became a model where the government realize the power of printing excess amount of money and pushing it into the economy. And every time government printed more and more and more money, it increased the velocity of money. Whenever more money was printed, almost every single asset class on earth went up in value. Now, the important point that you need to understand through this discussion is fairly simple, that in 2020 and in 2022, we have that same quantitative easing model at play. Yes, it is correct that the government in 2020 has printed insane amount of money, but please don't make the mistake of betting against the Fed. What is going to happen, as I've said on several of my videos, that if the governments feel that the growth is slowing down or a recession is very likely, what are they going to do? They are going to print more money. Every time they print more money, the velocity of money through the economy will go up. Every time they cut interest rate, the velocity of money through the economy will go down. And that is literally the single thing that is moving the stock market as of now. You can keep on applying MACD, RSI and different technical parameters. It will not help. The only thing that is moving the market right now is the flow or the control of the velocity of money. The money is drying up right now because the interest rates are being jacked up to control inflation. Going forward, if the growth slows down, the government is going to apply this quantitative easing model and will accelerate the velocity of money, and that will get reflected in the asset prices. Now comes the most important question, that what is it that we should be doing right now in the market? For this, you need to understand the second concept, and let Mr. Ray Dalio explain that concept to you.
So I remember when you would tell us that cash is trash.
Yeah.
Is cash still trash?
Of course cash is still trash. Cash, I'm asking you, you know how fast you're losing buying power in cash?
I feel that in terms of inflation every day. However, I'm also, for those who own equities out there, they're feeling it even worse.
Well, it depends what cash is. Equities are trashier.
So Mr. Dalio has been saying that cash is trash, and he's 100% right about that, because if you are putting your money in bank account, if the inflation is 8%, your savings rate deposit is 2%, then in real terms, you're losing 6% money. So therefore, cash is trash because you are 100% losing money. Second key thing, he said that equities are trashier. And we agree, but here we need to bring in Mr. Warren Buffett, because Mr. Warren Buffett recently put in $20 billion, which is not a small amount, and he put that money in today's market. So a more qualified statement would be that majority of the equities are trashier. Now, what are these trashier equities? So I can draw it on a spectrum. So if you consider this to be an entire spectrum, you can see some companies which are startup oriented companies, for example, they have no cash flows, they have no revenues, they were only surviving on funding. Their funding has also stopped, they have started firing employees. So these are probably the worst type of investments that you can make now. These are companies that have no cash flows and they have no revenues, no profits, and even unproven business model. A classic case in point is Paytm. It has corrected by a lot. Why? Because it perfectly fits the definition here. The second category of stocks that Mr. Warren Buffett is buying are these stocks. For example, they have consistent cash flows, they are revenue generating, they make profits, and they give out some kind of dividends. Here are two major investments that Berkshire Hathaway, the firm that is run by Mr. Warren Buffett, they have made $20 billion investments in two stocks right now. So let me explain you the nature of their work also. And if you want to purchase these stocks, you can use vested in order to make investments. The first stock is called as Allegheny, and its ticker is termed as Y, just Y. That's the stock that Mr. Warren Buffett has purchased. It's an insurance based firm. It's mostly a reinsurance, and 50% of its business come from reinsurance. In reinsurance, what happens is that if you have purchased your insurance from a certain company, you will continue or most likely continue with that same company itself. So there is a very high likelihood of revenue stickiness. So therefore, he has purchased this business. Second key business that he has purchased is Occidental Petroleum. So this is a Fortune 500 company that is into hydrocarbon exploration across different geographies of the world. And it is ranked 183rd company in form of revenues. Now I will double check this fact, but Mr. Warren Buffett is also making tech-based investments, especially in Apple right now and in HP. So these are some of the prominent cash flow oriented, revenue driven, profit making companies that Mr. Warren Buffett is purchasing even in this market. So yes, while Mr. Ray Dalio is right that cash is trash, equities are trashier, majority of the equities are trashier, but there are good pockets of buying opportunities that you should keep in mind. Please do not worry. Going forward, there is a very high likelihood that the markets are going to correct because there is correction that is happening in the bond market and it will get reflected in the equity market because of the flow of money. But there are excellent pockets of opportunities that are out there. If you want, I'll make a detailed video of all the stocks that Mr. Warren Buffett is buying and I will do a detailed analysis. In fact, I'm buying some of these stocks right now. So let's keep the like target to this video as 20,000. So if I get 20,000 likes on this video, I will release the video that day. But I hope you understand the opportunity here and continue to believe in Fed, because this dance is going to continue to happen till the time mad money printing ability is intact with the government. And I don't see that ability being changed over a short term. So I hope you enjoyed the video. Please press the like button and I will see you tomorrow.